Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, 10th of June. In a few hours from now, the US will release its latest inflation data, where headline inflation may have spiked above the 4% mark. Across financial markets, nerves are fragile. The data will land at a time Middle East tensions re-escalate, technology appetite is questioned, and technology space is preparing for the SpaceX IPO that could drain liquidity. Either way, today's US CPI report could determine whether the recent weakness in technology turns into a broader correction or a broadening of the rally to non-technology sectors. So we will talk about all that and more, but before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So the ceasefire, not that I would call it that, but flew out of the window yesterday after Iran reportedly downed a US helicopter, triggering fresh US attacks on Iran. Israel, on the other hand, never really ceased fire in Lebanon. So the Middle East headlines are uglier this morning than they have been for weeks. As a result, crude oil rebounded from yesterday's $86 per barrel dip, but to my surprise, holds below the $90 per barrel level this morning for the US crude, despite the rising tensions in the Middle East. Either investors continue to price in the end of the Iranian war regardless of the latest developments, or they don't care anymore about the headlines. But either way, every day the Strait of Hormuz remains closed raises the odds of a bigger oil price surge later on. Anyway, the fact that oil prices are not reacting violently to yesterday's news actually keep European futures steady and even slightly positive at the time I'm talking here this morning. We are just before the European market open. US futures, on the other hand, are pointing lower this morning following a volatile session in the US where technology stocks led major indices lower. AMD and Micron, for example, were down by more than 10% at some point in the session before recovering part of their losses, while the Nasdaq 100 dipped more than 4% at some point yesterday and closed the session more than 1% down. Technology, which has shouldered the market rally so far since the Iranian war started, is now giving signs of exhaustion. So overall, market investors' nerves look fragile this morning heading into today's next big data test, the US CPI update, and hopes and urge to chase the dips could evaporate in the blink of an eye. Because one, the last time the US released a major batch of economic data, that was last Friday's US jobs data, remember, markets descended into mayhem, literally. Bond yields spiked after a set of stronger than expected payrolls data and despite a softish wages growth, and the latter sent Nasdaq 100 more than 4% down, remember, almost 5% down actually. And two, well, the inflation data has gained all of its importance back since the Middle East war sent energy prices significantly higher, and since the US jobs market appears sufficiently strong today to encourage the Fed to look where it's more, say, uncomfortable, meaning to inflation. And in the particular case of the United States, gasoline prices rose by more than 120% at the May peak and remain around 80% higher today compared to the levels that we saw at the start of this year. Unsurprisingly, inflation data reacted immediately to rising oil prices. Headline CPI data in the US spiked to 3.3% a few weeks after the war started, then advanced to 3.8% level in April. We are talking about year-on-year figures, and the figure is seen crossing the 4% mark in today's May print. Core inflation, on the other hand, which strips out the volatile food and energy prices and which is more important for those who are trying to guess what the Fed will do next, may have risen toward the 3% mark as the higher energy prices spill over the economy. So what's important today is that both inflation metrics, both headline and core inflation, are significantly higher than the Federal Reserve's 2% policy target. As such, the rising inflationary pressures have totally shattered the expectation of a Federal Reserve rate cut later this year, and the Fed funds futures now price in the possibility of a Fed hike as soon as this October at a coin flip. And even the new Fed chair, Mr. Kevin Warsh, who is inclined to cut the interest rates and reduce the size of the Fed's balance sheet, will not be able to cut the interest rates when inflation spikes past the 4% mark. And on a side note, I don't think that he will be able to reduce the size of the balance sheet either. Pulling liquidity out of the market is simply not possible without causing a massive sell-off when the global financial markets have been enjoying and building on ample and parabolic liquidity injections since the global financial crisis. But anyway, without taking his defense, initially Warsh argued that technology advances and AI would be disinflationary and even deflationary because they would increase productivity, boost supply, hence pull prices lower in a way to pave the way for structurally lower rates. Now that thinking sure holds in the longer run, but in the shorter run, we have a problem, Houston. The Middle East war brought a completely unexpected flavor into the mix, which is a spike in energy prices. And you know what a prolonged period of higher energy prices mean. It means inflation. Also, the massive AI build-out today is accessorily pushing electricity and other raw material costs higher as well. So today's CPI data from the US will be important and closely watched. Obviously, it will be the last important data point before Kevin Warsh goes into his first FOMC meeting as the new Fed chair. Woo! As per the market reaction, a set of stronger than expected figures today could eventually echo similarly to what we saw last Friday, posterior to the US jobs data release, sending bond yields higher and stock prices lower. And note that the market moves could be as sharp depending on the data, but the market is so crowded today with bullish positions that even a small fear could turn into a nightmare. Figures in line or ideally softer than expected, on the other hand, could help avoid another risk sell-off like the one we saw on Friday, but will hardly reassure those who watch the news beyond technology and AI regarding what's to come. And even for AI and technology investors, rising yields could be difficult to ignore when the technology appetite is being questioned today due to sky-high valuations and a parabolic rise in market prices over the past few months. In reality, only the end of the Middle East war, reopening of the Strait of Hormuz, re-establishment of trade flows, and or a sustainable pullback in global energy prices would mark the end of the actual inflationary wave and push back the Federal Reserve and other central bank hawks out of the room and give a support to the financial markets, leading the way for a broadening of the recent technology rally that would also soften a potential pullback in technology stock prices. So fingers crossed for today's US CPI update. In the currency markets, the rising oil prices and a hawkish shift in Federal Reserve expectations threw a floor under the greenback's year-long depreciation between 2025 to 2026 against most majors. However, the fact that the Fed has remained relatively dovish compared to other major central banks and the broader loss of appetite for the US dollar and US treasuries due to the geopolitical uncertainties actually kept the upside attempts quite limited for the US dollar. But forgetting about the war for a second, the US growth has been stronger than many major economies thanks to the massive AI investment, massive AI build out and government spending, and the latter could maintain the dollar bulls in appetite when actual levels allow for further upside correction of the US dollar without necessarily reversing its longer term bearish trend. At some point in time, when the Middle East settles, the rate differential between the Fed and the rest will likely weigh on the US dollar appetite and give support to G7 peers. The million-dollar question is, when will the dust settle in the Middle East? So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.